This is a daily market rundown live from the Tradelo trading floor. It's April the 17th. Some highlights from today's show. Powell signals a lot more patience. The ECB is set to cut and signal, and gold continues to make history. Good day, traders, and welcome to what is effectively the last trading day for the week. We do, of course, go into the Easter break tomorrow. Now, that matters a great deal because I can tell you absolutely everyone I know is absolutely exhausted. So what typically happens when you have all this sort of adrenaline rushed type markets that we've seen, of course, since Liberation Day, is that typically people really want to kind of get beyond the key risk event and then they want to get the hell out of there. Okay, and I think that's the key theme for today, which is pretty much all of us are just going to sit here. We're going to watch the ECB, just see if Lagarde drops anything of relevance. Once she's said what she needs to say, I expect volumes are going to drop off a cliff, and it will just be up to the algorithms to do what they do best, which is a great deal of nothing. Now, that theme, we of course did see it yesterday, we saw it the day before, was that same sort of thing where no one was really doing anything. They were waiting for the key risk event, which happened to be Powell yesterday, and then once Powell cleared, we got a little bit of movement in the markets, but by and large, the theme for this entire week is a great deal of nothing. Okay, now with that in mind, let's get across and talk about our first theme for today. And it is, of course, just having a look back at Powell. What did he say? Well, he said nothing. He said more of what he told us 2 weeks ago, which was, look, we need to be patient. We don't quite yet understand the implications. We think that obviously these tariffs are going to have what is transitory inflation impact. In other words, short-term impact. They'll go through the market, they'll push up inflation a little bit, but then they'll subside. Okay, that's the general thinking of the chair. He does think inflation will be a little bit higher in the near term, but it'll be transitory. And then, of course, he did reference this idea of these tariffs can only be a little bit impactful on growth to the downside and at the same time have this near-term higher inflation. And with that in mind, the summary is, look, we've got to be patient. We need to understand this fully. Of course, they don't even know what the actual tariffs are that are going to be in play. They've got some sort of an idea with a lower bound of around 10%, but we don't yet know what that marginal tariff rate is coming from the US, and that's why ultimately Powell rather wants to effectively be a little bit more cautious and to do nothing. That is ultimately what he's leaning on. His policy is restrictive enough. We can keep it there for a little bit longer, make sure that the inflation genie is well back in the bottle. But in reality, he did say a great deal of nothing. Now, we of course had Trump come out this morning lambasting Powell, telling him, look, the ECB's cutting, they're getting on with it, and I can't wait to see the end of you. Now, again, I mean, this is not new news. He didn't like Powell for many years now. So, of course, that doesn't mean anything. He will need to go through some sort of a legal challenge to get rid of Powell. But the reality is that he does want a more dovish president. I think that's important because the next Fed chair is going to be a lot more dovish. They're going to be a lot more about a weaker dollar, about lower interest rates. And I think that really does matter because at some point when Powell does finish, of course, we can expect to see a far more dovish president coming to the Fed. Okay, now with that in mind, in terms of one of the key things Powell keeps referencing is this idea of soft versus hard data. So what is soft versus hard data? Well, soft data is typically your survey type data. Okay, so for example, we've been talking a lot about Michigan and Michigan surveys. Now, these surveys are important. They do matter. And typically, these surveys give some form of a lean or an idea of what the hard data may about to do. Okay. Now, very, very interestingly, when we talk about soft and hard data, the Fed doesn't make decisions off of the soft data. Okay. They make decisions off of the hard data. They really want to see the hard data start to deteriorate, and then they, of course, are forced into action. And what you're looking at on screen is effectively the City Index. It's a surprise index of effectively the hard data within the US economy. And if we go and reference ultimately last year, because that's when the market started to get a little bit panicked, starting in March, we started to see the hard data soften, and of course it then all sort of sort of escalated into what we had was that very, very bad non-farm payroll print in August. Okay, the reality is though, yes, the hard data weakened. It looked like a recession was incoming. The market was pricing in a recession. We were pricing in 6 or 7 rate cuts. The market was really getting ahead of ultimately the incoming recession. And the reality is we never had a recession. Okay, we bounced back as soon as the Fed cut 50 basis points and the hard data started improving from that point forward. Okay, now again, the reason I reference effectively last year is because if we look where we are on the hard data index, we're well above where we were last year, the worst points of last year. Okay, so this is why the Fed chair is really not coming out sort of guns blazing saying, look, we'll do whatever it takes to stop the unwanted volatility, we'll intervene with rate cuts, because in reality the economy and the economic data is just not that weak. Okay, and so that's the key takeaway, is that sure, Trump might be coming out and saying, look, why aren't you cutting? Look, inflation's doing this. Look. In reality, the hard data is not quite there yet. Okay, now, of course, this can deteriorate very quickly. We did have those retail sales out yesterday, and they were anything but weak. Okay, and so that's the key takeaway, is that data is going to matter. If we are going to see a recession or an aggressive slowdown, ultimately, the hard data is not quite showing it yet. Okay, but that does mean we need to be, of course, focusing on those key data points. And, of course, we will be talking about those on the show in the days, weeks, and months ahead. Now, in terms of gold, it continues to shine bright. It continues to set record after record. And again, I thought yesterday we would have a little bit of a blow-off top. It does seem like we have got that blow-off top, and we'll talk a little bit about the history of gold and what it looks like on a chart, and try and compare it, of course, to 08, as well as, of course, what we had during the 1970s. But in reality, gold is very much front running. It's getting ahead of a number of things, whether that's an incoming recession and a Fed that is about to ramp up quantitative easing, or a Fed that's about to cut rates very aggressively. It's getting ahead of that, of course. We, of course, have quite a significant amount of demand coming from the likes of China, particularly with what's going on around this tariff war. It makes absolute sense that Chinese investors are not wanting to hold US a safe haven like gold. We, of course, also have concerns around inflation, okay, and the inflationary impact of these tariffs. So, look, everything from a fundamental standpoint points to higher prices in gold. However, and this is the key takeaway, when I see a headline about gold is an uncertain certainty, that typically scares the living daylights out of me, because don't forget, a lot of all this risk off and China buying and tariff concerns, a lot of that is already reflected in the price. Okay, we did have Goldman Sachs coming out just recently, a couple of weeks ago, talking about revising up their gold target to around 3,700. Well, in reality, we're not that far away from there. Okay, we're a good, call it 8, 9, 10% from hitting that point, and it's only March. Okay. The point is that gold has already done 30%. Let me write that out. 30% since the November election. Right now, on a historical basis, that is quite a significant move. Okay. Now, it's not to say that we're not going to go up to Goldman Sachs. It's not to say that you must be shorting this outright, but it is to say there are always going to be tactical short-term tradable opportunities on the short side, just given how aggressive this market has moved, not just in recent days, but of course since that November election. Okay. The point is that there will be technical bear opportunities where you can take 2, 3, 4% moves out of the market. Fundamentally, however, from a trend perspective, this market's firmly to the upside. There's very little that suggests ultimately that this is going to have any kind of a deeper correction. But those short-term corrections are definitely on the table. Now, with that in mind, this is a little bit of chart porn that comes compliments of Daniel, Flow Trader on the Discord community. It's quite a cool chart to look at it. And what we're ultimately looking at here is taking the price of gold and we're comparing it against the 12-month average price. Okay, so think of it as a 200-day moving average versus gold. That's effectively what it is. Now, what you can see at the bottom here is effectively the distance between the price of gold, the current spot price, and the 12-month average. And we can see if we go back to the 70s, there was a very, very big dislocation back then for obvious reasons. Okay, we were running inflation well above 10%, and back then gold was an ultimate safe haven. There wasn't really much else as safe havens. Okay, obviously, fast forward 50 years later, we don't really want to look at the 70s too much because that was a time when financial markets were still in their infancy. They weren't as as developed as what they are now, and there weren't as many safe havens as there are today. Okay, so that sort of dislocation happened, but it was very, very much driven by this idea of hedging against sort of rampant inflation. We don't have that today. Okay, fine. If you look at the most recent inflation reports, we're running around 2.6% inflation. Okay, that's not too far off the Fed's target, and of course, with a slowdown in growth now coming in the US, it's very much expected that that inflation target is going to be hit over the course of 2026. But if we then fast forward to 08, keep in mind that was the Lehman Brothers crisis, you can see that gold ultimately initially rallied into that recession. Okay, once that recession hit, it very aggressively sold off. Okay, it was only when the Fed enacted QE 1, 2, 3, 4 twist, or QE 1, 2, 3 and twist, that we then saw gold really ignite and almost effectively doubled in price. Okay, now that was a very valid reason why investors front run what happened there. Everyone was thinking the same thing, and I remember this trade quite distinctly because we were talking about it every single day, which was, look, gold's going to the moon because we're going to see double-digit inflation again. The reality is we never saw anything like that, and gold gave up all those gains pretty much over the course of 14, 15, and 16. Okay, the point is that investors do hop on these trends. They do get very stuck into these trends when they think, we're going to get things like hyperinflation, when they think that the world's going to dump the United States dollar because there is no alternative, when the world thinks, they don't want to own US bonds because they're going to shit. The reality is investors jump on these things, okay? And they have jumped on it again this year. Right, for all intents and purposes, this is a chart that is very, very stretched. Okay, we're up from that 1800s. We started this rally in March of last year when Jerome Powell came out and said, look, ultimately we'll look through higher inflation to safeguard the economy. Okay, it was when ultimately the Fed prioritized the economy above inflation. Well, guess what? Fed's Powell now, over his last two speeches, has told us they're actually prioritizing inflation again over the economy. Okay, they want to see inflation coming back down. They want to ultimately ensure that we're not going to get a repeat of the COVID era inflation period, and that means they are reprioritizing higher, more restrictive rates. Okay, right now, markets thinking 3 to 4 cuts over the course of this year. If those don't materialize, gold is very much front running those cuts. It's front running a number of different things. Okay, so just keep on your alert. I'm not saying that gold is going to stage a straight line drop down, but we are effectively $1,500 higher. We've almost doubled in price since March last year. Okay, so keep a close eye on that. And we can see, of course, on the bottom there, we are now approaching those historically wide levels between the gold price and the 12-month. Okay. So keep an eye. Like I said, fundamentally, everything points towards gold, slowly moving its way up towards that 3,700 target, but it's March. We've got 9 months to get there. I do expect a decent correction coming in the gold. And I think we're already started. I think it began yesterday. Of course, we did get a little bit of volatility in the afternoon, which popped those prices up higher, but we are pretty much unchanged if you look at the two sessions combined. Okay, then turning our attention to ECB, it's ECB day. It's the key risk event, although the ECB has not been in the business of surprising markets for some time now. They're a little bit of a boring central bank, and Lagarde, unfortunately, doesn't make it very exciting. She is very much a politician. She doesn't make many mistakes, unfortunately, but we still watch it. We keep an eye on it. There's a number of things to focus on today. Look, the cut is all but priced in. It's all but expected. The market is leaning dovish. Okay, the market is pricing in another 2 cuts this year, leaning on potentially a third should the economic situation deteriorate. I think the key takeaway is contextually going into this. The ECB has told us they expect, if the tariffs come into play as per Trump's billboard, ultimately that will cut off 0.5% on GDP. So what that means ultimately is they are downgrading their growth expectations for this year. We do know as well that oil prices have dropped quite extensively, and they'll come in a lot lower than what the ECB's average price is for this year. What does that mean? Well, we know that Europe is very sensitive to oil prices, and in particular their inflation forecasts are very sensitive to oil. So what that means is right now we have an ECB that's got inflation almost back at target, almost back at that 2%, at a time when they're going to cut they're going to cut growth to the downside quite extensively, as well as, of course, cut inflation expectations as a result of what we are seeing in the oil prices. Now, The reality is, yes, I think the ECB is as uncertain as every other central bank, and we heard that from the Bank of Canada yesterday. They are reluctant to do anything brash right now, just simply because we just don't know what's going to happen with tariffs, and more importantly, we actually don't even know if they're going to prove to be inflationary or not. Okay, and so I think all central bankers are now in the business of being a little bit more humble. I think they learned their lesson post-COVID to not just turn up the dovish dial, and in fact just let ultimately the data guide the decision-making process. And so I think that's what we're going to see from President Lagarde today. Is a lot more humility, a lot more, we don't actually know what to do right now, and so the best thing to do is do nothing. Okay, so we'll see a lot similar sort of speech to what Powell gave us yesterday, which is, look, we just need to wait. We need the data to guide our decision making, and we've got policy back at neutral. Okay, right now the ECB has got interest rates almost back to neutral, so they are not restrictive. They, of course, are not accommodating, but they're not restrictive. Okay, and that's a good place to be. You've got policy, you've got interest rates where they're not effectively acting as an unwanted anchor on the economy. So why do anything in a rush? I think that's going to be the key takeaway from today, which is the ECB is not in a rush. Should things get a lot worse, should the uncertainty get a lot worse, should the volatility pick up, fine. They've got room to cut below neutral. They can support the economy if they need to, but they don't need to be coming out guns blazing, dovish, going into, of course, the next meeting, which comes in June only, where we get the new updated staff economic forecasts. Now, there will, of course, be some traders looking for something to do. This is very typical of us day traders. We're always looking for something to do. There'll be some perhaps adjustments to the statement. Do they ultimately maintain this reference in the statement of rates being restrictive? I think that'll be one to watch. I think it is largely expected they are going to drop that because we are now approaching neutral. So it's kind of a situation where if that stays in, it will be taken a little bit dovishly, just simply because it means that they are probably going to cut again in the June meeting. And the reason they would keep that in is because, like I said, they are downgrading growth quite aggressively. So that's something to watch out for on the dovish side. If it gets removed, is that hawkish? Absolutely not. Like I said, rates are back to neutral, so it's almost expected that this should be dropped out of the statement. Okay, and then of course there is some thinking that given all this pickup in the euro, we are seeing the euro up almost 11% this year. On a trade-weighted basis, the euro is not just outperforming the dollar, it's outperforming every damn currency around the world, and this again will impact Europe. Why? Because they're a very, very heavy export nation, and so a strong euro ultimately means they're going to start importing deflation. Okay, and if they're importing deflation, like one of the banks are talking about, there is every risk that ultimately we start to undershoot inflation. So yeah, do they come out and voice concern on the exchange rate? No, they typically don't ever talk about the exchange rate. They do say they obviously don't want to see it strengthen too much. But they don't generally comment on the exchange rate. But it is one of those things, if the ECB did want to combat further strength in the euro, they can, of course, turn a little bit more dovish, keep June live as a potential rate cut meeting. That being said, look, at the end of the day, I appreciate people will be looking at certain word orders. It's very unlikely the ECB is going to remove their data-dependent meeting-by-meeting approach. In times of uncertainty, this is absolutely the best forward guidance to have, which is, look, we will take this 6 weeks at a time, we'll assess the incoming information, and we'll act upon it. If things get a lot worse, if things get a lot more shaky, fine, then we've got room to move. Otherwise, let's not give any kind of overcommitment, and let's maintain all optionality. Okay, I think that's the key takeaway from today. We'll watch it. It'll be interesting. There may be absolutely nothing to do, and there may, of course, be something to do, but we'll keep an eye on that. In that sense, of course, the two key focus markets will be the euro and the Schatz. And there it is. I mean, you can see that euro, we, of course, started off with the German government coming out telling us we're going to spend a lot of money. That took the euro well bit up the page from 104 up to 109. And then fast forward to Liberation Day, we can see everyone is now treating the euro as some form of a safe haven, as some form of we'd rather own German bonds versus US bonds. As a result, we are seeing investors flock back to the euro. We have pivoted our way above key resistance 112 or 112.75. We've tested it once. I do expect we're going to sit inside this range for a period of time. Let those moving averages catch up. And let the market just absorb this 10% move. Okay, this is a significant move. Doesn't matter how you want to measure it, but I do expect a lot more sideways trade. Now, what that means is should the market try and bid up on something, Lagarde says, I do fancy a short side trade on that 114.50. I think you can absolutely sell it up there. And likewise, if we were to just offer down below those lows made this week, I do think you can absolutely buy it there. So it may just be a case of the opportunity today is nothing that Lagarde says, but perhaps something where the algorithms bring the technicals into play. Okay, so like I said, selling high, buying low, that might be the best play over ECB today. And then finally, Schatz, just to showcase it to you, I think the steepening is something to pay very close attention to. Of course, that steepening started with the German government. It continued somewhat with the tariffs. Why? Well, because these tariffs are going to prove to be stagflationary. So we get higher effective yields in the back end because of the inflation component. But then obviously the central bank is still cutting rates. And that's why we're getting that sort of steepener in both Europe, but more aggressively, of course, in the US. And you can see it there in the orange, we've got the 10-year bonds. In the purple, we've got the Schatz. And you can see the Schatz is pretty much taken out that German fiscal announcement quite extensively, and it's gone well beyond the gap. We are trading very close to the lowest yields we have been in a number of years. Okay, so going into this meeting, I think the key takeaway is the market is leaning dovish. We're pricing in 2 to 3 cuts. It's not that necessarily Lagarde is going to turn super hawkish. It's not that she's going to turn super dovish. The point is, markets are pretty much getting the message that the central bankers want them to get. And so, like I said, the opportunity scope is going to be more about where the algorithms bring the technicals into play. With that in mind, then, let's wrap up. It is, of course, Thursday before Easter. Everyone wants a break. Don't forget that. We do have some initial jobless. Definitely one to watch. Okay, initial jobless could be one of those early recession indicators. It is a form of the hard data, and we are at some point perhaps going to get a very smelly print out of it. So do keep a close eye on that initial jobless. But like I said, if everything comes in line, don't be overthinking it. Today's not a day to suddenly start trying to make your month or your year. Today's a day to get in, see what the ECB does. If they do nothing, switch off, go home, enjoy an Easter break. With that being said, good luck out there. Manage that risk. Go make some money.